Okay, we're going to start chapter 3, and probably going to refresh a little bit as we go from what we did the last couple of weeks since we had such a big break. So tonight we're going to be talking about adjustments. So we know that we talked about all the transactions going into a business, and we have to do those journal entries. We have to post those journal entries, and we're trying to recognize revenues when revenues occur and our expenses when they match those revenues. And sometimes that requires adjusting entries. And then we pull all that into a financial statement. So last class, we went through the process of taking a trial balance and taking those balances and putting them into the financial statements. So we're basically going to be doing the same thing, but we're going to be talking about the adjustments, and we'll do some examples of those. We'll do a couple of homework problems of those, and we'll walk through a few examples on all the different ones that you could see on a test or on homework. Okay, so we talked about a period of time. So we're always trying to measure what where the company is in a period of time. So we have our timing and reporting. Some businesses will have a calendar year, which will run January to December. Sometimes there's a fiscal year. It's 12 months, but maybe doesn't run January to December. Maybe it runs from September to August. And then we have natural business year, which is just when the year ends, is when the sales activities are low. That's when we want to end the business. And then we have interim financial statements. Interim financial statements, what that means is we're not reporting for the whole period of time. We're only recording, preparing these reports for just a small window within. So let's say we have calendar year, we have 4 quarters. The interim financial statement might be that I'm preparing a financial statement for first quarter, could be for second quarter, like that. So it's less than the whole physical year of the business. And then we have something called accrual versus cash basis. So accrual basis is what we've been talking about with our revenue recognition principle and our matching principle, some of those things that we went through in the first class. We have accruals, which basically means that we're not going to record things based on cash. So cash is pretty self-explanatory. If you spend money, that's an expense for the amount that you spent. If you take in money, whether you did it or not, that money is going to be recorded as revenue. So if you do an accrual method and follow GAAP guidelines, you're going to be looking at wanting to record the revenues when you're actually providing that service or that product. Maybe you got some money in advance. We talked about that a little bit. Maybe you got some money in advance. You haven't done the service yet, so you have an unearned revenue at that point. That's what accrual accounting is, and that's everything that we're learning in this class is accrual accounting. Okay, so we have some adjusting entries that we'll have to make, and we talked a little bit about these as examples. Prepaid expenses is one of them. Prepaid expenses could be supplies. Maybe we bought a bunch of supplies and we're going to use those over the next few months. We prepaid for those supplies. We have prepaid insurance. We will pay for an insurance policy that's for a period of time, and that insurance policy is going to bring us benefits through, let's say, the next 12 months, 24 months. And we want to recognize those expenses as we go. So we want to put it into a prepaid expense, which is an asset account. And it's going to sit there, and then over time, we're going to do adjusting entries to recognize a portion of the expense. We have rent. We can do the same thing. Maybe we paid 6 months of rent, and it's going to be a prepaid. And then each month, when we have to pay rent, we'll just go on that first of the month and do an adjusting entry. We've already paid it, so we don't have to do cash. So we're going to do an adjusting entry to recognize the expense. And then we have depreciation, which we'll walk through that separately. We're only going to do one type of example. We'll do depreciation later and do different methods of depreciation. Just know for now that there's depreciation on plant assets, fixed assets. When you buy a building, it's going to depreciate over time. And so that building might be depreciated over 39 years. And you want to figure out, is there a salvage value on some of your plant equipment, and how much time is the useful life of that equipment? You do all the calculations and you record an expense in a period of time that you're using that equipment and it's benefiting you for your revenues to come in. So there's different methods to do that, and we'll talk about straight line tonight, and we'll do that in just a few minutes. Okay, so when we do the adjusting entries, we're going to enter a journal entry and we're going to post that into the system. So a lot of times you may have a trial balance and you're looking at that trial balance, and you have just a list of the accounts with the amounts in your debit or your credit column. And then you'll see an adjustment that comes in that you do for the quarter or for the month, however you do your adjusting entries. And then you'll have an ending trial balance, and that'll be your adjusted trial balance. That's the one that you want to use to pull into your financial statements. So I'll show you what that looks like in just a minute, but I want to go into a little bit of examples on the adjusting journal entries. So we talked about having prepaid expenses. Insurance is one of the most popular prepaid insurance. So let's say we have a policy that's $12,000, and we're gonna have 2 years for that policy. So when I pay for it, I want to pay for the money all up front, the $12,000. So when I buy, let me get a thinner pen. When I buy that policy, I'm spending cash. So when I buy it, I know that my cash has to be a credit because I need to decrease my asset. So that's my credit side. My debit side is going to be prepaid insurance for $12,000. So this account, you'll have that policy in that account for 2 years. And each month that you, or each quarter, however you do your adjusting entries, you're going to recognize a portion of expense through those 2 years. And so over time, this will decrease. So your cash has already been dealt with. It's coming out of your bank account. So we put the whole amount in as a credit, and then it stays as a prepaid expense. Prepaid insurance is a prepaid expense, and it's an asset account. And so it's going to sit as a debit on your asset, on your balance sheet, as an asset on your balance sheet. And over time, you will expense a portion of it. So we have this policy that we pay in $12,000 for, and we're going to, let's say we want to do an entry for the month. So we need to figure out how much do I expense each month. So if I'm saying 2 years, 2 years is 24 months. All I want to do is take the 12,000 and divide it by the 24 months to come up with $500. So each month, this is what I need to recognize as an expense. So I'm going to do an entry for a debit to insurance expense, $500. And then my credit needs to reduce this asset, this prepaid account. So I'm going to credit prepaid insurance. That is going to decrease the balance in the prepaid insurance account. So if I'm looking at a T account, here's my prepaid insurance, and I have $12,000 when I purchased it. And each month you'll see an entry for $500. Okay, so my balance after the first month is $11,500. So that's what we do for expenses that we have that we've prepaid, and then we need to recognize them as we go. So another example on here was supplies. So let's say we bought supplies, of $2,000, and maybe we aren't going to expense that or do the adjusting entry until we know what we used. So we don't have a calculation to say, oh, okay, this $2,000 is going to last me 2 months and it's $1,000 a month. Maybe we don't have that. Maybe we do, but maybe we don't. So let's say each month you're going to do a count of what supplies you have left in order to determine what was it that I used. So I want to know, what did I use? So let's say the first month I used $800. So this is going to be my expense for that month. That's my adjusting entry. The example will say I spent, you know, $2,000 on supplies in the first month. I used 800 of those supplies. Or it'll say I have $1,200 remaining. And then you'll know, okay, let me just take and deduct that. If it says that I have 1,200 remaining, I'm going to deduct the, you know, that from the 2,000 and know that I've used $800. So when I do my journal entry, I have my supplies. Supplies is an asset account. So it's sitting as a debit on my books. So when I would reduce that, or when I want to decrease that account, I have to credit it. What is my debit? Well, I need to expense the part that I've used. So it will be supplies expense for $800. That's where I'm going to expense it. That's my debit. And then I'm going to reduce my supplies account by 800. So that would be an adjusting entry for supplies. Okay, let's use rent. So for rent, I'll go to the side over here. So for rent, let's say I pay 6 months and the rent is $1,000 a month. So I'm issuing a $6,000 check to pay for my rent. When I issue that check, I'm spending the money. So I know I need to credit my cash to reduce my cash. What's my other side to that? I need to debit an account where it sits and waits for those 6 months to come by for me to expense them. Where is that going to be? It's going to be in prepaid rent. So prepaid rent, $6,000 is my debit. And then I'll have cash, $6,000. So this is when I pay for the rent. My adjusting entry each month, I need to recognize $1,000 for rent. So my adjusting entry is going to be a debit to rent expense for $1,000. And I'm not going to cash because I already paid it, right? I need to reduce my prepaid rent, just like we did with the insurance. This is sitting as an asset on the balance sheet as prepaid rent. And I'm going to show it reduced now. It's not going to show 6,000 on the balance sheet after the first month. It's only going to show 5,000 because I'm going to do a journal entry to credit prepaid rent and make sure that it's being reduced over the 6-month period. So that's some examples of doing adjustments for some prepaid expenses. Now there's others that you could run into. There's examples of others, but the entries should be very similar to what we just did. You look to see what is your asset account. That asset account that has that balance is going to be reduced over the period of time. So that's going to be my credit. The offset to that is my debit, which is going to be an expense account. So whatever example they're giving you, the debit is going to be the expense. The credit is going to be the asset. So that's prepaid expenses. We're going to do depreciation now. We'll talk a little bit more about that one because it's a little bit different. So on those examples that I just did, we are going to do a journal entry right into the account that we're reducing. So supplies is the asset sitting on the books. When I do my credit, I'm crediting supplies and reducing that account. If it's the prepaid insurance, it's the same thing. I'm doing a credit to prepaid insurance. So I'm always going back to that account, and eventually this account will become zero. Depreciation doesn't work that way. It's a little bit different. So we are going to allocate a portion to expense each month, but we're not going to do a credit directly to the asset account. we have something called a contra asset account, and it's called accumulated depreciation. So on the balance sheet, you'll see equipment, maybe for $15,000. And then underneath it, you'll see accumulated depreciation. It might say equipment. A lot of times they're just lumped together. So you might have multiple assets. And then the accumulated depreciation will show as just one lump sum. It won't show under each one. But a lot of times on a company's books, in the chart of accounts, each contra asset account will have its own account for each fixed asset that you have. So maybe you have building, and then you have accumulated depreciation for building. You have equipment, you have accumulated depreciation for equipment. You have land improvements and accumulated depreciation for those land improvements. So it's always going to be a separate account and it's going to show as a credit. So let's say I already depreciated $5,000. So this is what it looks like on your balance sheet. Okay, it'll have your asset and it'll have your accumulated depreciation listed underneath it. So you need to know that so that when you do your adjusting entry, you don't adjust it to the equipment account. So let's look at this example. So we paid $100,000 for this equipment, and we have a salvage value of $500. So what we're going to do tonight is just straight line depreciation. Straight line means we're just going to look at it and see how long is this useful life, and then we'll divide it over that period of time. So when you're doing straight line depreciation, it's going to be the value that you paid for the asset, and then you'll deduct the salvage value, and that'll be divided by the useful life. So you want to make sure on straight line depreciation you use the salvage value. So I'm not going to take $100,000 that I paid for that and divide by 5, because then I wouldn't have the right amount for my adjustment. I have to take the $95,000 and divide that by 5 in order to come up with the correct amount. So in this example, it would be 100,000 minus 5 divided by 5 years. That's going to give me $19,000 per year. Okay, so let's say we only do an entry to adjust for depreciation once a year, and it's at the year end. I've worked for companies that have done depreciation where they recognize the expense every month. And I've also worked where we've done it quarterly. And where I'm at now, we just record depreciation at the year end. So we don't do it throughout the year. So we're going to do a journal entry to recognize the expense for $19,000 for that current year that we use that equipment. So remember, my equipment is sitting on the books with a balance of $16,000. It needs to stay like that. We're not going to ever adjust that once we buy it. It stays just like that. So now I need to expense a portion of it. So that's my debit, because I know that debits are an expense. So I'm going to have equipment expense for $19,000 for the year. And my credit is going to be my accumulated depreciation for equipment, $19,000. Okay, so same concept. We're just not going to use the same asset account. We're using something called a contra asset account. And that's always going to be where the offset goes to reduce the balance or the net book value that you have on your assets. It's going to show up on your balance sheet, just like we did over here, where it'll have the equipment total, depreciation, and it'll have a net book value. So in this case, this one's 10,000 is my net book value of my assets. Okay, so that is the only method we're going to learn for tonight. Just remember, when you're calculating this, that you're taking the amount that you paid, the value of the asset, you're deducting your salvage value, and then you divide it by the useful life. That's what you're going to expense for your period that you're going to expense it for. Okay, we also have adjustments. We have deferrals for revenue or unearned revenue. This is where I was talking about maybe somebody paid us some money and we haven't done the job yet. We haven't sold the equipment yet. So right now we have it sitting on our books as an unearned revenue. Well, an unearned revenue is a liability account. So instead of having a debit balance, it's going to have a credit balance. Okay, so maybe I have, let's see what my example is. Let's say my unearned revenue is $5,000. So it's sitting as a liability, as a credit on my books for $5,000. My example says that we've earned 1,000 of the unearned revenue in the period that we're adjusting. So for my journal entry, I want to reduce my unearned revenue because right now it's $5,000. It's sitting as a credit, so how do I reduce it? I have to do the opposite. So I'm going to debit unearned revenue for $5,000. I mean, I'm sorry, we're doing $1,000. Okay, and then I want to recognize that revenue. So now I'll have a revenue account. You know, I don't know if it's product revenue or if it's sales revenue, consulting revenue, but it's going to be a revenue account that you're going to recognize as a credit for $1,000 because we want to put into our income what we went ahead and we did the consulting service. So now we want to recognize a portion of that revenue. So the debit is unearned revenue, credit the revenue account. So the unearned revenue now on my T account, unearned revenue, it's sitting as a credit for $5,000. I just did an adjusting entry for $1,000. So now on my liabilities, I only have a balance of $4,000 in my unearned revenue. So that's an adjusting entry for that. Then we have something called accrued expenses. Sometimes we'll go through the period and we'll come to the period end. Maybe we haven't gotten an invoice yet for something that was done. Maybe we want to recognize a portion of expense or interest into the period, and we haven't paid the salaries out yet, or we haven't paid the interest out yet, but we want to go ahead and put in the portion that belongs to that month. So in that case, we have to set up the expense, which is a debit. And then we have to set up a liability because we haven't paid it yet. So instead of reducing like in prepaid expense, we already paid that out. We were reducing the amount in an asset account because we already paid it. And so we're reducing it as we go. We're debiting an expense. This is a little bit different because we haven't paid it yet. So maybe I have taxes that are going to be due at the year end and I want to accrue those as I go. I'm going to be setting up the expense, which is the debit, but the offset, the credit, is not going to be to an asset account because I didn't pay for it yet. It's going to go to a liability account. So it may be called interest payables or rent payable or salaries payable or taxes payable. Some liability account is going to be credited in order to recognize that expense in that period of time. And then I'm setting up a liability to tell me later, I have to go back and pay that. I'm liable to pay this later. So that's how I record those adjustments, is put a liability on the books to tell me to pay it later, and I can get that expense in when I need to record the expense. So let's say we have to accrue interest of $500. So maybe a portion of the interest period is in this current month, and I want to recognize that $500 as an expense. So interest is just going to go to interest expense for $500. And then my offset to that is going to be a liability. So it's going to be interest payable. And this lets me know that I'm liable to pay in the future the $500. So that's interest. Let's say we have rent, same thing. So we have rent of $500. So we would just do rent expense, $500. And then we would have a rent liability account or a rent payable, let's say. So $500. Taxes, same thing. It'll be tax expense, $500, tax payable, $500. Salaries can be the same thing. So we'll go through in another chapter, salaries in detail, because you also have withholdings. And so you'll have payables for taxes, and you'll also have a payable to pay the employees, the net amount. So we'll go through in detail in a couple of chapters for that. Okay, so that was accrued expenses. So all of these things that we just did are adjustments. So there's things that there's transactions that have happened through the year, and some things happened maybe months ago, and we put those things on our books. We posted those journal entries, and they're in our trial balance, but we need to adjust those balances. And so there's questions that can come in that will say, okay, right now you have a balance of $10,000 in supplies, but the balance needs to be $5,000. How do you do the journal entry? Or it may say you have supplies of $10,000 and you've used $5,000. What is the journal entry for the adjusting entry? It's always real good to look at dates, because sometimes maybe you pay for an insurance policy that's for 12 months. You want to make sure you're dividing it by that 24 months to capture just the 1 month that you want. Or maybe you paid for it on July 1. So if I paid for the $12,000 policy on July 1, I need to know how much do I need to record an expense for the 6 months that I had it. So you have to look at the dates and say, okay, well, I know that my policy is for, 12 months. I'm gonna divide it by that, and then I'm gonna multiply it by 6, because I'm gonna record it for 6 months. Or maybe it says you're gonna record it for 3 months. So those are some of the things that you want to be careful with. Just know how to calculate it, and then make sure you read the details to tell you, how much am I expensing? Is it 1 month? Is it 3 months? When did I buy the policy? When did I buy the equipment? So that you know how many months you have to expense it for that period. Do we have any questions so far? Okay, so we have a trial balance, and this is the adjusted trial balance. This is what it would look like. So here's my list of my accounts. I have my debits and my credits where it says unadjusted. And then here's my adjustments. So I have all these different little transactions that happened for me to make my adjustments. And then I have an ending adjusted trial balance. These are the numbers that you want to bring over to the financial statements. Okay, these final numbers that come in here. Once you've added those adjustments into the account, then you will bring those over. Now, what I do want to mention, we talked about different softwares that people use in business. What happens is with these adjustments, a lot of times they are entered through a journal entry. So this will be somebody entering in a journal entry into the computer. So a lot of times we don't maybe look at something that looks exactly like this. Maybe I ran a trial balance and I got my numbers, and then I made some journal entries, and then I run another trial balance and it has just updated amounts. It's not going to say, here's your adjustments, here's your ending. You might just get a report that just has the new balances. So it won't always look like this, but know when you put the journal entry into the system that it's doing that posting for you, that we're learning that you would have to do that posting into an account here in class manually. So you'll have to say, okay, so for accounts receivable, I had a 0 balance, but I did an adjustment of 1,800. So I'm going to add the 1,800, and here's my balance. So the computer will automatically do that for you. So know that a lot of these numbers are coming from transactions. And then when you do your adjustments, the majority of them are going to be through journal entries. So a lot of times you'll do accruals because maybe you don't have the bills yet. We know that at our buildings that we have electricity we pay every month, and it's for a period of time. And a lot of times, maybe it runs from like the 15th or 16th of the month. and then goes to the middle of the next month. So what will happen is at the end of the month, let's say it's the end of September, I'm paying that bill that I just got for Entergy that ran through the middle of September. Well, I don't have a bill yet for the rest of September because I won't get that until maybe late October. And I need to close my books. So what I do is make an estimate. And I say, okay, this is what I think it's going to be for the 15 days in September based on previous bills. And I'll make that adjustment into September to make sure that I have a full 6 months of expense. So that is a lot of what happens when people have to do accruals at a business. Is a lot of times you have things that haven't come through yet. Maybe there's some jobs that are in process and you have some, some equipment that's been used, some inventory that's been used, you've had some labor that's been used, you have work in progress. So you want to recognize some of those expenses to recognize the portion of that job that's complete. Maybe it's 50% complete and the job was $100,000. So I'm going to do an entry to record the portion of that job that's complete. So I'm going to recognize $50,000 worth of expense. So there's a lot of different reasons why people do the adjustments for the accruals. Sometimes it's real simple. Sometimes it's a little bit more complicated. It depends on the type of industry that you're in. Okay, once we do all of our journal entries to do our adjusting entries, let's say it's year end. Maybe we are a business and we're running our operation from January to December. I just did all my adjustments and I finished doing everything for the year end. So I feel comfortable that my trial balance is correct and I'm ready to pull it over to my financial statements. Once I've reviewed everything and everything's correct, my financial statements look good. Now it's time to close the year. So my period runs from January to December, which is 12 months, and I want to close that. And we talked a little bit about revenues and expenses. Every year, we want to look at that as a new period. So we know how much did we make last year? How much did we make this year? The balance sheet accounts, those are always there. We want to make sure that we still have on the books, okay, here's my accounts receivable. At the year end, I don't want to wipe them out. Why? Because that is a permanent account that somebody owes me money. Well, just because we hit a new period doesn't mean I wipe out everything that everybody owes me. It doesn't mean I get to wipe out my debt for the new year. That kind of stuff has to stay on the books. All of my equity that I've put in the common stock, that all has to stay on my books. So we're not going to close anything like that. That's called a permanent account. It's permanently there. I want it to run from period to period, and it's going to stay on the books until either we've used the supplies or we've sold the equipment or we've, reissued and bought back all the stock, and then we wouldn't have any more stock. So there's going to be something that happens that's going to get rid of those accounts. It's not going to be through the closing process. The closing process is going to work on only those temporary accounts. So all of your income accounts, all of your expense accounts. Dividends is an expense that you paid out for that year, a portion of what you made in the company. So I want to make sure I go through the process of closing those out. And I put a note here that you might want to go look at. Let me see if I can open it up. There's a PowerPoint that I put on Moodle, and there's slide number 49 tells you, I think it's the one that tells you the temporary and the permanent accounts. So I felt like this might be a good slide for you to look at to kind of memorize which ones are closing and which ones would stay on the books that are permanent. Let me find that for you. Okay, so this is the slide here. So it tells you your temporary accounts, so your revenue, expense, dividend, income summary. That income summary, we're going to talk about that in just a minute. And then we have our permanent accounts. That's our assets, common stock, our retained earnings. Remember, everything rolls into our retained earnings. And then our liability account. So that is a good slide for you to look at to memorize which accounts are which in the closing process. Once we set up the income summary account, the income summary is a new account for the year end, and basically it's going to catch what we're closing. So when we have our financials and we have a revenue account, how is that sitting on the books? It's sitting as a credit. So let's say our sales for the year were 100,000. And then we have all of our expenses, and they're on the books as a debit. And let's say they are 90,000. So this is the total of everything. So how am I going to close these? I have to do the opposite to remove them. So if my revenue is sitting as a credit, I need to debit my revenue account for the 100,000. And let me see if they got an example here. I don't think they do. Okay. I was looking to see if the PowerPoint had an example to show you, but I don't think they do. Well, kind of. I'll show you this because it has everything listed out. Okay, let me bring this over. All right. So here's all the expense accounts here. And all of these expenses are a debit. So what needs to happen is they have to go into the income summary, and they have to have as a credit in order to wipe them out. And then when you have your revenue accounts, you want to put them in as a debit so you can wipe those out. And then the difference is going to get rolled into your retained earnings. So that's how you would close all of your accounts. So we had 7850 here. That is going to be a debit to my my revenue account. So when I debit the revenue accounts, I have to do the opposite on my income summary, right? So my income summary is going to get that total that was in my revenue. It's going to go in as the opposite. So I'm going to have a credit to my income summary. So here's my revenue, $100,000, wipes this one out. My expense is on the books as a debit. So I'm going to have to do it as a credit. And those opposite of that is going to be the income summary. So in this case, I'm just going to net it. So my income summary is going to get $10,000. This is the net. That's going to get moved into my retained earnings. So on the sheet, which, let me see if I can find it here. So on the sheet, you'll see my income summary, once it cleared off all of the expenses and the revenues, was a balance of $37.85. That $37.85 rolls into retained earnings. Retained earnings is your beginning balance plus your net income, which is what that is, less your dividends, and that gives you your ending retained earnings. That's your ending balance. So that clears off all my temporary accounts, all my expense accounts, all my revenue accounts, my dividends, and it rolls into retained earnings. That retained earnings rolls into next year, and it stays on my balance sheet. Okay. So then we have an accounting cycle. It's all the steps in preparing the financial statements. You can go look at it in the notes. I'm not expecting you to remember those and be able to memorize them for a test, but I do want you to understand the process of what's happening and knowing that you're starting with a transaction. There has to be some sort of transaction to begin the cycle. So we have a transaction, we have to analyze that transaction. What do we need to do with it? Then once we know what to do with it, we put our journal entry on the books. The journal entry goes on the books, and then we have to post it, which means it goes from the journal entry into the accounts, and we record it in those individual accounts. Once we have the amounts in the accounts, we can run our trial balance. So we have an unadjusted trial balance. Then we do adjusting entries. Then we come up with an adjusted trial balance because now we have all those adjustments that we had to make that go into the balance. So it's an adjusted trial balance. And then after we have that, then we can start the process of preparing the financial statements. And once you have your financial statements, you'll have those for your interim periods, maybe it's quarterly, so you have first, second, third, fourth quarter. Once you're finished with fourth quarter and that calendar year is completed, you want to close those temporary accounts, so you go through the closing process. A lot of the software companies that people use for their accounting will do the closing process automatically. You will not have to do the journal entries for that. There are some older systems that require you to do those closing entries still and bring those balance forwards in those permanent accounts, but a lot of companies already do that automatically for you. So once you say you want to close the year of 2021, once you say close it, the system will automatically go through and do everything it needs to do to bring it into the retained earnings. You won't have to do that you won't have to do that manually if you have that type of software. So that is the whole process in the accounting cycle. So okay, then we have our classified balance sheet. So this chapter talks a little bit about a classic balance sheet. We looked at the balance sheet. We kind of listed out like accounts receivable, cash, fixed assets, or equipment, whatever we had. Maybe accounts receivable, maybe notes receivable. We just kind of listed them out. So the format of a classified balance sheet will list out in categories. So you'll have the current assets, and that will be this classification structure where it's only the current assets, and that would be anything due within, you know, the year, the other assets that you have that you're going to be using up through the year. And so you want to make sure that all your current stuff, like your cash, maybe it's anything that you're expecting to sell that year. It could be those accounts receivable because you know you're going to collect on that this year. It could be anything that has to do with your operating of your business would go into your current assets. And then you have your non-current assets, which are long-term. So anything that is a long-term investment, those plant assets that you've purchased that you're going to be using for years. It could be land and land improvements. Those are over a period of time. Intangible assets will be something that's going to be on your books for long periods of time. So they're just classifying it into these categories, and that's how it's listed in that format. That's what a classified balance sheet is. Same thing with liabilities. You have your current, which is under the year, and then you have your non-current, which is your long-term, or long-term liabilities might be what they call it. And then you have your equity section. So your equity section, remember, that is your owner's claim on those assets. And that'll be like your retained earnings and your common stock accounts. So you want to make sure that you have that listed separately. Okay, and then here's our two formulas for this week. We have profit margin. That's the measuring the ratio of a company's net income to sales. So we want to look to see what is the return on our sales, profit margin. A lot of times, you know, companies that are selling products, sometimes they may get very little profit margin. Maybe it's only 8%. And there's other businesses that are maybe getting 25%. So you just take the net income and divide it by the sales to come up with your profit margin as a whole. And so you'll have a homework problem to do that. And then you have current ratio, which is it assesses the company's ability to pay those debts in the near future. And so this is the asset. I mean, the formula for that is current assets divided by the current liabilities. So we're only looking to see what we're collecting, or what kind of assets do we have now on hand versus what do we have in debt now on hand, this current period, this year. So that's our current ratio. So you want to do those two. You'll have two examples. You'll have to remember those because those will probably pop up on the test. Okay, let me open, I'm going to open Connect and just do a couple of examples for the homework. Do y'all have any questions? Nothing? Sorry, my internet is very slow. I have to use the Verizon MiFi little card thing because my internet is still down at home. It was working, but it's been down again since yesterday, so it's still not 100%. So it's a little bit slow. So we're going to look at number 6 first.
Are we expected to understand everything you're saying so far? Because I'm still, you know.
Still a little confused?
Yeah.
I wouldn't expect that you would know everything that I just said just because I said it. It's going to take you reading the chapter. It's going to, I'm recording, so it's going to be on YouTube. You can re-listen to the parts that you want to get explanation again. But when you read it and you start working through the problems, then you should start to understand some of the things we talked about.
Yeah, I would agree with whoever that just was that spoke. And I was doing the homework, and as I started understanding it, then I all of a sudden just lost it, and it got really confusing again.
Mm-hmm. It can be. And sometimes the way that it's presented can be a little bit confusing too. So hopefully going through some of the examples that we went through will help explain some of that. But it's really going to take reading and working through the problems to try to understand it, and then maybe even going back and re-listening to the lecture. Sometimes it takes a little bit for people to understand, and then some people have to have, tutoring as well on the side to help kind of fill in the gaps when you're still confused. So hopefully you can have enough time to get it all before the test though. Okay, so this problem, we're looking at depreciation, and we went through an example already, talking about how we calculate how much needs to be expensed for the year. Talks about what accounts to use when you do those journal entries. So for step 1, it says determine what the current account balance equals. So they want to know, after you read it, what is the account balance right now before you make any adjustments. Step 2 says determine what the current account balance should equal. So instead of saying tell me what the adjustment is, it's saying what should the account be. So you have to know how to calculate the adjustment to know what it should be, right? And then it says record the transaction. So we're going to walk through this one. It says the Krug Company's accumulated depreciation account has a $15,500 balance to start the year. Now it's telling me that this is not the asset account of the equipment or whatever it is. It's saying that it is the accumulated depreciation. So immediately when you see that, you know that this has been already adjusted to decrease my asset because it's sitting in accumulated depreciation. Accumulated depreciation is an asset account, but it's a contra asset account. So it's not sitting with a normal debit balance like assets normally sit. It's sitting as a credit because it's offsetting that money that you've already spent on the asset, that value that's there. It's reducing that because you've used it for a period of time. So the accumulated depreciation is $15,500. So step 1, it says determine what the current balance is. Well, that's what it is. It just told you $15,500. Is it a debit or a credit? Well, it's accumulated depreciation with the contra asset account. So even though it's an asset account, it's not a debit. It's sitting as a credit. That's why you have to select credit there. Okay, and then it says a review of depreciation schedules reveal that $17,000 of depreciation expense must be recorded for the year. Now on this example, you don't have to do the calculation that we did because it's already telling you how much needs to be expensed for that year. It's saying that 17,000 needs to be expensed for the year. So we know the amount. If I know that it needs to have further adjustments of 17,000, I already had 15.5. I need to add those together to come up with what my ending balance should be in the account, the accumulated depreciation. So it's showing, and I don't know if it asks you to fill this in on this side over here. It might, you might have to put those amounts in there. I'm not sure. So the 15,500 put there. The 17,000 is my adjustment for the year, my current adjustment. And then I'm going to add those two together to get 32,500. So when it says determine what the current balance should equal, the 32,500 is what it should equal, because I need to do that adjusting entry. What is it going to be sitting as? Well, again, it's accumulated depreciation, so it has to be a credit. All right, so what does the journal entry look like? So this is the same. We did this earlier. We need to recognize an expense. Expenses are debits. So I'm going to do depreciation expense, not for the 32,500, because remember, the beginning balance was 15,500. That's already been expensed in a previous period. This period, we needed to do 17,000. So that's all I'm going to pull is 17,000 for my depreciation expense. And my offset is accumulated depreciation. That's my credit for 17,000. So if I have a balance of 15,500 as a credit, and then I just did an adjustment for accumulated depreciation, a credit for 17,000, they're both on the credit side. So I know I have to add them together. Does that make sense? Hopefully that makes sense. So I'm gonna see if I can move this to the side. I don't know if y'all can see that. I can't move it out the way. Okay. So B says the company has only one fixed asset. It has a truck that was purchased at the start of this year. That asset had a cost of $48,000. So that's what I paid for it. That's the value of my truck. And so remember I said in the first class that we have to have value to record those, right? So that's how much we paid for it. That's the value of it. That's what it's going to go on the books for. It's saying it has an estimated life of 5 years and is expected to have a 0 value at the end of the 5 years. So it's a 0 value at the end. There's nothing to deduct from it. It's 5 years and it cost me $48,000. In this case, they're asking you to calculate what is the amount going to be for this period, because it didn't give it to me. I have to calculate that out. So determine the current balance. What does that equal? Well, I didn't have it before, right? I just bought it this year. So there's nothing accumulated from the previous period coming in. So it's just 0. There's nothing there. And then I got to calculate out. How do I calculate it out? It would be the value of the truck, which is 48,000, minus the salvage value, which is 0, divided by 5. So 48,000 divided by 5 should give you the 9,600. That is going to be what is expensed this year for the truck. So it says determine what the current balance should equal. It should equal $9,600 because it's only going to be that current year that we're putting on the books. It's going to be a credit because it's going to be accumulated depreciation. That's my credit. And so my ending balance will be 9,600. All right, so the journal entry. The journal entry, I'm debiting depreciation expense truck, 9,600. And then I'm crediting accumulated depreciation for the truck, 9,600. Okay, C says accumulated depreciation again. The company has only one fixed asset, equipment, that was purchased at the start of this year. That asset has a cost of $40,000, has an estimated life of 7 years, and is expected value of $6,400. Okay, so now we have to do calculations again. What was it at the beginning of the year? At the beginning of the year, it's 0 because we didn't have the equipment before, right? We just bought it. So I want to take $40,000 and deduct my 6,400. I think that's 6,400, which is the value that it's expected to be at the end of the 7 years. And then I want to divide it by 7 because I'm using straight line depreciation. And I want to make sure that I deduct that salvage value. Don't just take the 40,000 divided by 7. when you deduct the 6,400 from the 40,000, you get 33,600. And then I want to divide that by 7 years. So in these examples, we're assuming that they want us to do the whole period. Are y'all still there? I don't
Yeah.
know.
Yeah.
I don't know what that was and why it popped up like that. That was weird. Okay. So when I do my journal entry, I'm going to expense only the portion for this year, which is the 4,800. So my balance is 4,800. It's accumulate depreciation, so it's sitting as a credit. Ending balance is going to be 4,800. My journal entry is debit the expense account for equipment for depreciation, 4,800, and then credit accumulate depreciation equipment for 4,800. So that gives you three. Your numbers will be slightly different, but it gives you three parts. So you have 3 times to work through the depreciation. You'll see this again. We'll have a chapter that'll give you all the different methods. But this is, this is going to stay the same. You're always going to have your depreciation expense and credit your accumulated depreciation. Okay.